You don't find out you bought too much house when you sign the papers. You find out 6 months later. The HVAC dies, property taxes go up, and your insurance renews higher than expected. Suddenly, the house you were proud to own starts telling you what you can't afford anymore. That's the part almost nobody puts in the calculator. This is the kind of math we run every week on Montel Finance. Here is the question we're going to keep coming back to. Can you still build wealth after the mortgage gets paid? Not can you qualify. Not can the bank approve you. Those are completely different questions. By the end of this video, you'll have a simple framework you can run on. Your own numbers to figure out whether a house actually fits your financial life instead of just your lender's requirements. Because banks are solving one problem, you're solving another. A bank wants to know whether you'll probably make the monthly payment. You need to know whether buying that house quietly steals money from everything else you care about. Say you earn $90,000 a year. A lender might look at your income and your debts, then decide you're approved for a certain loan amount. That's useful information. Approval isn't affordability. Those are cousins, not twins. Think about two hypothetical buyers. Jake buys the biggest home the bank says he can afford. Every raise over the next 5 years disappears into housing costs, maintenance, and higher bills. Marcus buys something below his maximum approval. His monthly payment leaves room to invest, build an emergency fund, take vacations without using a credit card, and handle surprise repairs without panicking. Same income, same lender, very different financial future. That's why this video isn't about chasing the biggest number on a mortgage pre-approval letter. It's about finding the number that still lets your money work for you after closing day. Over the next few minutes, we're going to break this down by income tiers, from entry-level earners to high-income households, and look at the trade-offs each group faces. Along the way, we'll also cover the expenses that almost every affordability calculator glosses over, and why they can completely change your decision. If you remember only one thing from this video, make it this: a house is affordable only if it still leaves room for your future. Every section from here on out is going to test that idea from a different angle. Here's a quick test. If someone offered you a house for $100,000, less than the maximum you qualify for, would you feel like you were settling? Or would you actually be buying yourself more freedom? That question changes everything. Remember our anchor. Can you still build wealth after the mortgage gets paid? Because that is the test, not the approval letter. The biggest mistake people make is treating affordability like a single number. It is not. It is really 4 different questions hiding inside one. First, what can you qualify for? That is the bank's math. They will look at your income, existing debt, credit profile, and other financial details to estimate what monthly payment you can reasonably support. Useful? Absolutely. Complete? Not even close. Second, what can you comfortably pay every month? That is your math. Maybe you like traveling twice a year, helping your parents, or you have kids in daycare. Maybe you are maxing out a retirement account because future you matters just as much as present you. The bank doesn't know any of that. You do. That is why 2 families earning exactly $150,000 can have completely different affordability limits. Same paycheck, different priorities. Neither is wrong. They are just solving different equations. Now let's add the third question. What does the house cost after you own it? This is where online calculators start getting optimistic. Your monthly housing cost isn't just the mortgage. Depending on the property, you might also have things like property taxes, homeowners insurance, maintenance and repairs, utilities that are higher than your previous place, or homeowners association dues if the neighborhood has them. Individually, none of those sounds terrifying. Together, they can completely change your monthly budget. Here is a hypothetical example. Let's say 2 homes have nearly identical mortgage payments. One is a newer home with lower maintenance and no homeowners association. The other is older, needs regular repairs, and has monthly dues. On paper, they looked almost identical. In real life, one quietly costs hundreds more every month. That is money that never shows up in the mortgage calculator. And then there is the fourth question, the one almost nobody asks. What is the opportunity cost? Every extra dollar tied up in housing is a dollar that can't do something else. It can't build your emergency fund. It can't be invested. It can't pay down high-interest debt or buy flexibility if life changes. Housing isn't competing against doing nothing. It is competing against every other financial goal you have. That is why our anchor matters so much. Not, can you make the payment? But, Can you still build wealth after the mortgage gets paid? Let's make this real with three hypothetical buyers. Sarah earns $70,000. David earns $140,000. Chris earns $250,000. You would expect each one to simply buy a more expensive house. Sometimes that is exactly what happens. Sometimes it shouldn't. Because as income rises, something interesting happens. Lifestyle expectations rise even faster. A larger home often comes with larger furniture, higher utility bills, more expensive repairs, pricier neighborhoods, and a growing list of costs that don't appear in the listing price. More income doesn't automatically create more financial freedom. Sometimes it just creates bigger fixed expenses. That is the trap, and it is surprisingly easy to fall into. Because every monthly payment looks manageable by itself until they are all added together. Take a step back, and you realize the real decision isn't about buying the nicest house you can afford. It is about deciding how much of your future income you want permanently committed to housing. That is a very different conversation. Before we look at specific income tiers, there is one mindset shift worth making. Don't ask, how much house can I buy? Ask, how much life do I want left after buying the house? Those questions can produce dramatically different answers. Here is where this gets interesting. You can double your income and still end up less financially secure if every extra dollar goes into a bigger mortgage. That is why the anchor keeps coming back. Does this purchase still leave room to build wealth? Let's run through three hypothetical income tiers. These aren't prescriptions. They are examples to show how the math changes as your income changes. Tier 1, around $60,000 to $90,000 a year. At this income level, your biggest advantage isn't buying the biggest home possible. It is protecting your margin. A single unexpected expense, like a car repair, a medical bill, or a job transition, can put pressure on your monthly budget if nearly every paycheck is already committed. Let's say you receive a raise. The temptation is obvious. A bigger paycheck means a bigger house. But what if that raise instead gave you breathing room? An emergency fund that actually stays full, retirement contributions that continue every month, and the ability to replace an appliance without reaching for a credit card. Those things don't look exciting on closing day. They feel incredible 2 years later. This is where many first-time buyers accidentally confuse ownership with financial progress. Owning a home can absolutely be part of building wealth, but only if the home doesn't prevent you from building wealth everywhere else. Tier 2, around $100,000 to $180,000 a year. This is where lifestyle inflation becomes much sneakier. You can genuinely afford more house. The question is whether every upgrade is worth its long-term cost. Maybe the neighborhood is nicer, the kitchen is larger, or there is an extra bedroom. None of those are bad decisions. The real question is, what are you giving up in exchange? Suppose house A leaves several $100 each month available for investing or other financial goals. House B uses nearly all of that extra cash flow. Over the course of years, that difference doesn't just affect your savings account. It affects your options. Changing careers becomes harder. Starting a business becomes riskier. Taking unpaid parental leave becomes more stressful. The house isn't just using today's money. It is quietly claiming tomorrow's flexibility. That is why our anchor still applies. You already know the test. If the payment grows, but your financial freedom shrinks, was it really an upgrade? Tier 3, around $200,000 plus a year. Here is the surprise. Higher income households often face the exact same psychological trap. It is just wearing a more expensive suit. Instead of asking, can I afford this home? The question becomes, everyone in my income bracket buys houses like this, shouldn't I? Comparison gets expensive fast. Larger homes often bring larger ongoing costs. More square footage, higher utility bills, more maintenance, more furnishings, and potentially higher property taxes and insurance. The purchase price isn't the finish line. It is the starting point. That is why some high earners still feel cash-strapped. Their income grew. Their fixed expenses grew faster. The paycheck got bigger. The breathing room didn't. If this framework is helping you see housing differently, subscribe. This is exactly the kind of financial math we break down on Montel Finance. Now here is the honest catch. You've probably noticed. I haven't given you one magic percentage or one universal affordability rule. That is intentional, because personal finance is, well, personal. A household with no debt, stable income, and a large emergency fund may comfortably handle a housing payment that would create enormous stress for another household earning the exact same salary. That is why rigid rules eventually break down. Frameworks last longer than formulas. So instead of chasing someone else's number, build your own decision process. Ask yourself, if my income stopped growing for 2 years, would this payment still feel manageable? If a major repair showed up next month, could I handle it without panic? Am I still consistently investing for retirement and other long-term goals? Does this purchase support the life I want, or force me to organize my life around the mortgage? Those questions are harder than typing numbers into a calculator. They are also far more valuable, because once you've answered them honestly, the right house usually becomes much easier to recognize. Let's go back to where we started. 6 months after closing, nobody asks how much the bank approved you for. What matters is something much simpler. Can you pay your bills without stress? Can you handle surprises? Can you keep investing in your future? That has been our anchor from the beginning. Can you still build wealth after the mortgage gets paid? Because that is the difference between buying a house and building a financial life. Think back to our 3 hypothetical buyers. The first protected their financial margin. The second resisted letting every raise become a bigger mortgage. The third realized that a higher income doesn't automatically create more freedom if every upgrade comes with permanent monthly costs. Different incomes, different decisions, same principle. Here is the mindset shift I'd love you to leave with. A mortgage is one of the biggest financial commitments most people will ever make. That means it is not just a housing decision. It is a cash flow decision, an investing decision, a career flexibility decision, and even a lifestyle decision. Every dollar that goes toward housing is a dollar that can't do something else. Sometimes that is exactly the trade-off you want. A home can provide stability, convenience, and a place to build memories. And those benefits absolutely matter. But the mistake is assuming the most expensive house you can afford is automatically the smartest financial choice. Sometimes it is. Often it isn't. The smartest purchase is the one that supports the rest of your life instead of competing with it. So before you fall in love with the square footage, the kitchen, or the backyard, run one final test. Picture yourself 3 years from now. Your income hasn't changed much. Your car needs repairs, the water heater just failed, a friend invites you on vacation, and your retirement contributions are due this month. Does your housing payment still leave enough room to say yes to the things that matter? If the answer is yes, you're probably looking at a house that fits your life. If the answer is no, it doesn't matter what the lender approved, because you've already found your limit. Affordability isn't defined by your best month. It is proven by your average month. And that is the month you'll live through over and over again. Buy the house that grows your future, not the one that consumes it. This video is for educational purposes only and does not constitute personalized financial advice. Take 10 minutes today and write down every monthly housing cost, not just the mortgage, then rerun your budget with those numbers. I'd love to know what one feature you'd happily give up if it meant more financial freedom. And if you enjoy breaking down money decisions with real-world math instead of hype, subscribe and we'll keep running the numbers together.